Welcome to the ongoing series of online discussions hosted by the Yale School of Management Office of Alumni Relations and Yale Insights, the Yale School of Management's publication looking at global business. Today's conversation is, does the past help us predict the future of financial markets? We'll be discussing how upheavals in the markets in recent years have affected expectations for long-term returns and volatility. I'm Ben Madison, Managing Editor of Yale Insights. I'll introduce our panelists and start things off with a question. Roger Ibbotson is a professor in the practice of finance at the Yale School of Management. He is founder, advisor, and former chairman of Ibbotson Associates, now a Morningstar company, and is currently chairman and chief investment officer of Zebra Capital Management, a global asset and hedge fund manager that focuses on capturing liquidity premiums in global markets. Carl Essig, a member of the Yale SOM class of 1980, is a partner at AgFe, a London-based financial advisory and asset management firm that is one of Europe's leading specialists in complex financial assets. Prior to joining AgFe, Carl worked for Morgan Stanley for more than 25 years, during which time he advised on and arranged financial transactions for governments, corporations, and financial institutions from the firm's offices in London, New York, and Tokyo. Andrew Golden, a member of the Yale SOM class of 1989, has served as president of the Princeton University Investment Company, the organization responsible for managing Princeton's endowment, since January 1995. During that time, the assets of the endowment have grown from under $4 billion to over $17 billion, after net withdrawals of more than $7 billion to fund university operations. We welcome your participation in today's discussion. You can submit questions and comments through the question box to the right of your screen. I'll start things off with a question for Roger and then ask Carl and Andy to give us their thoughts. Roger, in 1976, you and Rex Sinkfield calculated the long-term stock market return starting in 1926, and then you used that data to extrapolate the return for the following 25 years. Do you think it would be possible today to make such a prediction, or have factors like globalization, automated training, or new investment vehicles weakened the link to the historical pattern?
Well, I think we could definitely make those kind of predictions today. I haven't done it, but I did actually make it in 2000, and I probably missed on that one. Just to review this a little bit, though, in 1976, I looked at 50 years of data from 25 to 75, and I basically extrapolated that data, really extrapolating the risk premiums after you start out with the riskless rates, which were risk-free rates were quite high at that time. But adding the risk premiums, the historical risk premiums to it, and I made predictions about the market and where it would be in the year 2000, both stock and bond markets and inflation and so forth. It turned out that I almost hit it right on the button in 2000. So I said that, for example, the Dow Jones would hit 10,000 by 2000, and it did. However, I guess you can't get overconfident about these things, and they asked me for another forecast at the time, of course, and so I projected that the Dow would hit 100,000 by 2025. Well, that's not going to happen, I can tell you with almost assurance, because we're halfway through that period now, and we are nowhere near. The Dow just hasn't responded. Basically, we've been through a period where we actually had two really big weak markets. First of all, the tech bubble collapse, which started right at the beginning of 2000, and then later the financial crisis, which collapsed the bond markets as well, and all the distressed markets, especially the distressed bond markets and so forth. So we went through that kind of a really poor period. So yes, I could make these forecasts again. They would be much lower forecasts. The stock markets would be more forecast more like 7%, because the base level of riskless rates is so low. So we could make those kind of forecasts again, and they would still be relatively optimistic from what some people think. But I think that in general, I think actually I am optimistic about markets when you look at it from the long term anyway.
Andy,
Go ahead.
Andy, do you think about markets in these terms as you plan?
Well, we definitely think about the long term, and long term maybe even goes out beyond 25 years. For our work, we don't need to nail a particular asset category's return with great precision. We just want to think about what the relative ranking is likely to be, and emphasis on the word likely. And when you these series, the historic series, um, even when they go for multiple decades, still tend to be endpoint sensitive. Um, and so maybe a little bit of massaging of that can help you get a sense. But as I said, it's the relative ranking that really matters. And we think about not just risk premium, but really discomfort premium, because you kind of think about markets reacting to investor enthusiasm, and investors are probably less enthusiastic about things that are likely to give them discomfort. And those type of things seem to be largely stable, but not completely stable over time. And that's where it gets interesting in the not completely stable part of it. But I guess I'll pause there.
Carl, do you have it? Carl, do you have any thoughts?
Well, I do. I'm always troubled in one sense by the idea that somehow within this whole discussion there is some fundamental value to which asset prices return. I think most people would say that, yeah, we go through periods of time where we have shocks where there's a deviation on one side or the other. But there's a sense that somehow they're at the bottom of all this. When you smooth out the ups and downs, we end up at some sort of notion of fundamental value. I'm maybe more skeptical about that because I'm personally convinced that there are some very, very significant longer-term supply and demand dynamics that probably drive this. One classic one, I would argue, is demographics. So while you take a look at a market like Japan, and we all know that in 1989 it was at a unrealistic level. It's obviously crashed since then, and it's not recovered. Now you could say take a lot of different views about why that might be, but I would posit that at least one significant issue involved there would be that the demographics of Japan have changed so significantly that the demand for equity is just fundamentally different today with an older population than it was then, and in a relatively closed system like Japan. I mean, closed in the sense, obviously anybody can trade Japanese equities, but the fact is that the interest is predominantly domestic. I think that factors like the demographics overwhelm whatever one might think otherwise about fundamental value in the market.
Well, speaking about the demographics, of course, it's not just Japan that's aging, although they're probably at the extreme end, but of course, Europe is definitely aging, and even the United States is aging, although not as much as Europe or Japan. So all the developed markets generally, and it's just the way the sort of the demographics work. As you get richer, you tend to have less children, and so all the developed markets are aging. So, just Carl, does that mean that you think that you'd be pretty negative on equity markets, just in general across all the developed markets?
Well, in one sense, yes. I actually think that there are very significant paradigm shifts that occur from time to time. Demographics just happens to be one of them. And that, yes, those are the things that we need to keep in mind. I mean, take the absolute level of interest rates is a very interesting one. I mean, did anybody on the phone today think that we'd be sitting with, virtually zero interest rates in all of the developed countries around the world at the same period of time for a really significant period of time. I think most people would have said no if you asked that question 10 years ago. It's hard to imagine how that would be the case. So I think there's clearly paradigm shifts. And whether those are fundamental to where we are today or within the last 10 years or so, as opposed to where the world was, Roger, when you were looking at it for the 50 years from 26 to 76. Yeah, maybe that is a new phenomenon, and maybe there were just many more influences on the markets that more influences that the markets picked up or something. But yeah, I'm a believer that there are very significant paradigm shifts that we all have to be very, very cognizant of.
Well, Andy, what do you think? Because you're of course even a more long-run thinker than I am. Of course, I've been accused of being such a long-run thinker at times because I look at historical data going 80 and sometimes even 150 years back. But Andy, you actually look at this sort of permanence of the university. How do you see this?
So, Roger, are you calling me a broken clock? Is that? Look, I think once in a while there can be a paradigm shift. The Fed changing its approach to interest rate targeting. What is that? Almost 30 years ago. Is that right? Maybe dividend yields changing their relationship with other forms of interest yields, in the 50s, I guess. But I think you got to be a little skeptical of how often that happens and what mechanisms there are for funds to flow to take advantage of that. And so again, maybe at the margin, you could talk about shifts in natural appetites of riskier securities. Although I remember the Beardstown Ladies Club, which comprised some older folks who seemed to be pretty enthusiastic about equities, even though they were older. So I'm not sure I want to put too much weight on certain assumptions like that. And as I said, you can't really, it's much harder to predict absolute returns than it is relative returns. And the fact that equities do cause greater discomfort to the holder suggests that they'll probably do better over very long periods of time. Not that there won't be periods in which a fixed income security will outperform, and even prolonged periods, but you kind of go back to theory to solidify your views, and then look at that long-term data, long-term history to sanity check those views.
Well, you look at the long-term data, bonds, of course, have done really great in the last 30 years. Actually, not any better than equities, roughly about the same as equities. But starting in 1980, when bonds were in double digits, double-digit yields, we had double-digit inflation at the time, of course. And as those yields dropped, we had a very good bond market returns over that period of time. So they not only got the yield, but they got the change in yield, which gave them capital gains. So we had this very great long period in the bond market, which we had comparable returns to the equity markets, but with much less risk. But now when we sit here today, and I'll address this back to Carl, when we sit here here today, we end up with a basically less than 2% yields on, say, 10-year bonds, and as you go to shorter-term bonds or cash, the yields are close to zero. So are you a proponent, Carl, of you seem a little negative on the stock market, but the bond market, at least if you look at it in relative terms, like Andy said, how do you see the bond market doing?
Well, I think you're right to point out it's hard to imagine that you could stay indefinitely at this absolute level of interest rates around the developed world. I mean, that it seems to me that you have to be of the view that somehow all these aggregate budget deficits come back to play into inflation and so on, don't they? At some period of time here in the future. Obviously, it's going to be hard to predict when, in fact, that is. So, no, I'm not suggesting for a moment that you want to stay in the fixed income world indefinitely. That said, I think the interesting question about how long we stay in here is fraught with a number of complications, not the least of which is the political issues that are related to keeping the interest rates low in all of these countries. And I might be surprised at how much longer it lasts than I would even imagine.
Thanks, everyone. I'm going to jump in for a minute and just remind our listeners that you can submit questions for our panelists, for any one of our panelists or all of our panelists, by opening the question box on the right side of your screen. So feel free to send us your questions. And I thought I'd bring in another topic, related topic. And I'll start with Carl on this one. Carl, do you have a sense of how what is perceived as a safe asset or a safe investment has changed over time, over the last few decades, and what has been the implication for global capital flows as people have moved from one type of a security or another?
I think it's a really interesting question, and I suppose we have to start with some idea that, to me, that safe is a kind of relative idea, and by that I mean, is a government bond safe? Well, we all could say, yeah. I mean, we tend to try to look at that as the proxy for the risk-free rate. But I guess that's okay if you happen to be sitting inside that country and that's your perspective. But clearly, a government bond in a foreign currency, from your perspective, has any number of interesting characteristics that probably make it less safe in terms of its return. You might be able to argue that you'll get your 100 back, but the 100 could be worth a whole lot less. Frankly, even within a given country, is the U.S. government bond today safe in terms of its return? If we're right, and inflation comes back into play, well, it's not going to be safe from a return standpoint if interest rates are at 10% before it gets to its maturity. So yes, I think the concept of safe has moved around a lot over my period of time in the market, and a lot of it is heavily dependent on where you're sitting at some point in time and what you're trying to manage your portfolio to.
Well, can I have a follow-up question on that, Carol? Because you've been involved in securitization, and actually, one of the things that securitization has attempted to do is to slice and dice securities in such a way that they actually end up with perhaps a big AAA piece in the end, and much more than you would be if assets were pooled. If you actually looked at what's underneath the hood, the assets aren't so safe, but perhaps the way they're categorized and tranched into slices and so forth, there are big chunks of safe pieces that get the first priority of claims. How do you can we make a lot of extra AAA assets out of perhaps weaker, more default prone assets?
I would have said no. I mean, one of the huge problems with the securitization market as that technology eventually got used, I would say probably abused, is that people started thinking that you could diversify away, lots of the risks, and that somehow the fundamental risk that you were diversifying away in a Florida residential mortgage portfolio, you could diversify more of it away if you combined it with a Missouri portfolio and a California portfolio. And I think that was nonsense, and certainly proved to be, and certainly all the, the CDO squareds and all those things which came about subsequently were clearly mistakes. Now, having said that, if you were to look at the European securitization market over that same period of time, where subprime mortgages were not securitized, where CDO squared and all those strange things were not created, if you looked at the AAA assets, securitized assets, you would see that virtually none of them had a credit problem through the whole of the financial crisis. So yes, I think the technology, when used correctly, can certainly get you to a very secure, from a credit standpoint. Obviously, interest rate risk and credit spread risk can move around, and indeed did move around over time. But done properly, it does work. When abused, it's a pretty dangerous mechanism.
Andy, do you have any thoughts about this from your vantage point, and how you you think about different asset classes in your investment?
Yeah, I think an underappreciated concept is that safety and conversely risk really need to be understood within the context of mission and objectives. Given our, as an example, given our mission, which is to try and spend at a pretty high rate, maybe even an audacious rate of 5% of the endowment, but to preserve the purchasing power of the corpus around that, we have this need to produce very high returns, and so just the quick little thought experiment of this idea of a risk-free rate. Let's describe a treasury bill as the kind of classic safe investment, at least as would be taught in class. There's no way that that's going to produce anything close to a return of 5% above inflation. So in some sense you could call that risk-free, because there's absolutely no risk of achieving your objectives. You're guaranteed to fall short. And so for all these discussions, I said you have to really think about what you're trying to do. For us, it's much less risky in terms of our mission to get involved in more aggressive positions, the price of which is, of course, the discomfort of knowing that you're likely at some point over one's career to look quite silly when some of the volatility that tends to come with those more aggressive positions does appear.
I certainly agree with Andy that the discomfort, you call it discomfort, I've certainly called it lots of other things over time, but essentially that in order to get high returns, you really have to buy the types of securities that other people do not want. And actually there's a over demand for the really safe type of security, and the limited supply. And so it turns out that the return turns out to be really low for those types of securities. In order to actually get some return, like that 5%, you really do have to actually take on, it could be risk, it could be we have products at Zebra Capital that are based on less liquid. It could be liquidity, it could be risk, it could be just something about securities that people don't like. Whatever that is, though, those are the types of securities you have to buy and actually to meet these kind of long-term goals. Andrew,
The one thing I would add. Oh, sorry.
Go ahead. You go ahead, Ben.
Sorry, it was Carl. The one thing I was going to add to it is, isn't it interesting to see how the notion of the risky end also changes? So I spent a lot of time with hedge funds and opportunity funds and such over here, who, until recently had return targets of 15, 18%, those kind of numbers and higher, and more recently have said, gosh, we can't get there. And are saying maybe the number is now 10 to 12, and you have to ask yourself the question, did all the risks of the things that they look at change? Did the universe of the things they were looking at decline? Was there too much money like them chasing them and change the return? So there's an interesting, relative to Andy's earlier point about relative things, how relatively these risk features change, or risk returns change, even within distressed or those kind of asset classes.
I'm gonna jump in with a question from our audience, and maybe we'll start with Andy on this one and take it from there. So the question is, the average annual compounded yield of the Fed funds rate from 2002 to date is under 2%, the lowest in history. Do any of our panelists feel that the Fed has an exit plan?
That's a great question. I would remind the questioner that Ben Bernanke is a former professor at Princeton, and therefore I've tremendous confidence that he and his colleagues are thinking a number of steps ahead. So, and if you just look at some of the academic work that they've produced before, you would know that they do have a strong sense about the importance of inflation. So I would say yes, they do have an exit plan. Getting from here to there will be an interesting show.
Well, that's it. We could ask Andy what the exit plan is, but he probably has so much inside information that he just can't reveal it at this point.
I'm certainly not going to give it away for free. Yeah.
Actually, the Fed balance sheet has really blown up. It not only holds a lot of treasuries, but it holds even mortgage-backed securities, and a lot of other different types of securities. So the Fed is actually, I think actually Bernanke did a wonderful job in the financial crisis itself of providing a lot of liquidity to markets and blowing up that balance sheet. But the exit plan is a whole other matter. How do you change, and how do you get out of this? And Carl knows a lot about bonds, so maybe Carl can tell us what to do here. What is the plan?
Well, I don't know what his plan is. What I would say is it's not just his problem, right? You would look at the ECB as well, and the same phenomenon has gone on, right? They have many assets in addition to mortgages sitting there, having done the same things that the Fed has done. And I think it's one of the, $60,000 questions is how you unwind those positions without having an impact on interest rates. I don't personally see how you're going to be able to do that. So then doesn't it come down to doing it at the, quote, right time, which presumably means after you've had a recovery of some magnitude. In either the United States, maybe that's sooner than in Europe. We certainly aren't looking at much of one over here. So gosh only knows.
I think that the time This is obviously a tough situation with such a big balance sheet from the Fed and how they exit and unwind it. But I look at 1980 when Carl graduated from the School of Management. That was a time to me that I would say might have even appeared worse. In 1980, the unemployment rate was 81, the unemployment rate got over 10%, but we not only had the high unemployment at the time, we also had double-digit interest rates and double-digit inflation. And somehow we got through that kind of a crisis. And if anything, I'd say today's crisis looks kind of mild because we don't have any inflation. We do have the big Fed balance sheet, and we do have the problems of but our even our unemployment is below 8% today, so it hasn't come down like it is supposed to have come down. But the time doesn't seem quite as bad as it was in 1980. What do you think about that, Carol? You were there, thinking about these things.
Well, I must say I was there insofar as I remember in my first assignment at Morgan Stanley all those years ago, we were doing bond deals for major famous American corporations with 18% coupons. And my God, you certainly would have wanted to have a 18% double A U.S. corporate bond in your portfolio, 30-year bond in your portfolio, wouldn't you? When you know what happened subsequent to that. Of course, this is in some sense going the other direction, right? Because there we had to go from a high interest rate environment to a low. And here I guess what we're all saying is it's hard to see how we go from this low interest rate environment to somewhere else without a pretty big impact on interest rates, particularly as you point out with the Fed and the ECB long as many securities as the two of them happen to be. And honestly, with as I said, a little near term, and that meaning near term meaning the next couple of years anyway, prospect I think in most people's mind over here in Europe for any kind of recovery. It's going to be a challenge, big challenge.
I'd like to thank our listeners for their questions and comments, which have been coming in. We appreciate it. Here's a question. I'm going to start with Andy on this one. The question is, given the boom and bust of the past few years in most types of real estate, what sort of percent allocations to real assets are appropriate in portfolios with long horizons, and why? And I'll just add, I don't think you necessarily need to put a percentage on it, but we'd appreciate your thoughts.
Well, look, it really depends again upon your objectives. You know, in the answer to the previous question, there was the implication, that at some point inflation is going to likely to rear its head. We don't know when, and so while there's many difficult things about our mission of having it earn high returns forever, there are some easy things, which is ability to take the long-term view and to recognize that things that are likely to do well in an inflationary environment probably have a role and a significant role in the portfolio. So the boom and bust in real estate has not really given us any pause, well, it gave us pause, but it didn't cause us to change our thinking about the appropriateness of real estate in the portfolio. And so we're as committed to it and other forms of real assets as we were before. It's interesting because a lot of this is the whole theme of this panel is about can the past predict the future, and within real estate there's certainly been a bifurcation of recent past returns. The world seeking yield has certainly driven up the price of certain kinds of very clean properties in central business districts. But a lot of things are still not recovered, and it's an interesting question of, given the kind of weak returns of those other segments, do you use the past to say, well, that's not any good, don't invest in things like that, or you say, well, now's exactly the right time, and take the contrarian view. And I think that's more where our heads are.
Carl, I don't know if you have any professional uh, work in this area, but do you have any thoughts?
Um, you know, I agree with what Andy said. I think that you have to take a view that real assets of some kind are important in any portfolio, and particularly one over a long period of time. I think what's interesting is, what kind of real assets do you want to have in there? Obviously, real estate is one of them. We've spent a lot of time looking at airplanes and ships, which are, two other really big asset classes. They're something like $1 trillion worth of airplanes flying around the world. There's $100 million of them, $100 billion of them, $1 billion of them order on delivery every year for the next 10 years or something like that. Obviously, some of them will be taken out of service and so on, but in any event, it's a very significant real asset class, and it's an asset class that's kind of bumbled along, to be honest with you, in terms of return perspective for a pretty long period of time here. Query whether that's an interesting one at some point in the cycle. Shipping, of course, is one that's been incredibly volatile and has been really at a low point and getting lower for several years now. There's a lot of people out there, professionals in that arena, who think it's a good time to buy ships. And if you take a look at the history, for those who believe in looking at the past, ships, almost more than any asset, you can make 40–50% returns on your asset in a single year if you get the timing in the shipping industry right. But there's a lot of paradigm shifts going on, I think, in the shipping world, not the least of which is the movement perhaps of a lot of manufacturing back to the United States. If our cost of energy stays low, what does that do for the number of ships that have been put into service to move goods from China/Asia into the United States? Interesting question. Does that mean that it stays down for some period of time? I raise that only because I think there are other kind of real hard asset classes out there that people probably ought to think about as other components of a portfolio.
U.S. real estate, of course, we had a big drop and not much of a recovery so far, but there have been recoveries in some of the luxury financial markets, like London, especially, of course, and but also other of the major markets around the world, like Shanghai and so forth, or Sydney. So, how do you perhaps do you think real estate will pick up in the U.S. At least in some of these sort of key markets? What do you think about that, Andy?
Yeah, again, I think there still seem to be opportunities. Obviously, real estate's a very broad category, and I remember being taught that there were three really important things about real estate. It was location, and I forget what the third one was. And so, I think you can imagine, some fairly broad trends in the areas that have not seen the rebound. I just wouldn't know when that might start. And I think it would not be the first time when different property types were working on their own cycle. So, it'd be a good bet to make that there will be some variation across the category. And so, again, the kind of bottom line is we know we'll be happy to have owned real estate. We just don't know when we'll be happy.
So I have a question from the audience. I'm going to start with Roger on this one. One of our audience members asks, can you talk about prior inflationary periods a little bit? For instance, how have equities performed leading into inflationary cycles versus after inflation hits? Have the
Well,
markets done a reasonable job pricing in the inflation?
well, just in general, markets don't like inflation. Partly because you can think of a stock as a present value of some cash flows uh, with a discount rate, but the discount rate, one of the pieces of the discount rate is inflation. And when you have high inflation, you have higher interest rates, and higher interest rates basically discount the cash flows to lower numbers. So markets don't like the increases in inflation. They don't like the high inflation rates. Um, at least, especially the increases, though. Actually, the high inflation themselves doesn't so much hurt the markets, but the change. So if we get a change in inflation eventually here, it's probably a little bit weak for stock markets and bond markets. So, and by the way, our inflation is pretty close to. It's only a couple of percent right now. We do have the danger of inflation from these stimulation policies that we've talked about, but we don't really have it yet. When we had the high inflation, especially in the late 70s and the early 80s, it was really a difficult time for the economy and for markets. And as we improve that inflation, that's when markets really, both stock markets and the economy, seem to take off. So, yeah, if we get back into that high inflation market, we're going to be in some trouble.
Carl or Andy, do you have any thoughts about that?
Well,
Go
I guess
ahead.
I'll jump
Yeah.
in and say, uh, again, compared to what? Um, so stocks maybe don't like increased inflation, but I think bonds like it even less. And so that's the that's the relative question.
Well, and presumably there are stocks which are sensitive to real underlying assets, in which case they may benefit, right? I mean, it's not necessarily every share will fall.
I do think, though, it's in general true that uh, rising inflation is going to hurt both stock and bond markets, perhaps bond markets worse. It sort of gets back to what we asked Andy about earlier, though, is he he at Princeton, and of course our Yale endowment faces the same problem, having something like 5% spending rules in an environment where you start out with very low interest rates and perhaps not necessarily potentially not strong returns in stocks or bonds. How do you actually achieve that 5% and the 5% real in times like this?
Well, it does involve getting involved in taking on a lot of various forms of discomfort. The so-called endowment model does certainly involve a willingness to get involved in less liquid assets. The lack of liquidity creates a couple different forms of discomfort, including, not just that you can't necessarily get your money when you want it, but you don't necessarily even know how much money you have at any one given point in time. So that's part of it. Another important part, though, is the hope that there actually are sources of alpha above the market. And even though we were taught that alpha is a very rare commodity, um, we still have this kind of, again, audacious belief that maybe we can garner a little bit more of that rare commodity than some others. And in any environment, we've always felt that the kind of risk-free rate was not going to really provide much overinflation. So whether or not it's providing somewhat less than usual is not as big a factor as you might think.
By the way, alpha itself is a zero-sum game, so that if Carl and Andy came up with some alpha, either in the stock or bond markets or any of the markets, of course, there's got to be other people who have negative alpha,
Right.
and because overall it has to sum to zero. So I have no doubt that our my fellow panelists here, Carl and Andy, might be able to get some positive alpha, but just in general, we collectively as investors cannot. And in fact, with the various costs and fees in the various products that we might invest in, we're going to have really, on average, negative alpha.
Here's a question from the audience, which I think is a good one, given Carl's global outlook. The question is, emerging market country balance sheets now look better than developed markets, while the global equity correlations have been rising. What are the implications for global asset allocation towards emerging markets in the future, both equities and debt?
Well, I think it's right to say that looked at from a balance sheet standpoint, you'd have to say that developing markets, and there are many of them, look a lot better than the developed world. And we mentioned earlier the challenges that the U.S., Japan, and Europe have over the next, we'll call it a decade anyway, as they sort of work their way through the balance sheets that the central banks in those places have. So yeah, I would definitely say that you've got to be in developing markets. Now recognize that there are plenty of political risks that have little to do in some cases with the position that you're putting on. So you've got to be selective and careful in doing it, although as a general matter, I think you'd have to argue that there are attractive returns that should be available out there in the developing world.
Yeah, one of the general problems is that even though emerging market countries will do well, their economies may do well or have a lot of growth in them, it doesn't necessarily, or even the entrepreneurs in those countries might do well, but it doesn't necessarily translate into our shares that we invest in from those countries. So I'd like to. I know Andy invests in all kinds of places and so forth. What's your perspective on actually the connection between the returns that the shareholders might get and is actually earned in the country?
I think it's a great question. I think emerging markets or developing markets play a very large role in our portfolio, both the public markets and private, and we've focused a lot of effort. In fact, we've articulated in 2004 what we call our grand unifying theme of the importance of enhancing our networks, our foreign local networks, both intelligence networks and manager relationship networks, all over the world, with some emphasis on the developing markets. In fact, I spend last year I spent as much time in cities in China as I did in New York in terms of trying to develop those relationships, which is a long-winded intro to. I think this is an area where it may be more plausible for us to get some alpha. You will again point out that that's a zero-sum game, but we're putting in the effort to try and figure out who the best partners are, so that we're on the right side of that zero-sum. And I think there are lots of reasons in specific situations to be quite hopeful that the return to the equity holders will in fact be quite good. And of course there are lots of reasons to be quite concerned that everything can go right with a company in some of these jurisdictions, and an investor like us will not see any of the benefit. If Warren Buffett talks about if after 15 minutes you can't tell who the patsy is in the poker game, you are the patsy. We don't even need the 15 minutes. We kind of walk into these things knowing that we're at a disadvantage, and it's a pretty interesting challenge to figure out how to work to overcome that, at least marginally. And the answer is in making sure that we're um, partnering with good people who've been playing in that card game for a little longer than we have.
Here's another question from our audience, and I'm going to start with Carl on this one. Can you speak to how many asset classes you consider, and to our larger theme today, how has your weighting in these classes changed over time?
Oh gosh, I think we better turn that to Andy in particular. I don't run a big portfolio here, so I don't think I feel confident answering it.
There's been the quick answer is we think of things across 7 different asset categories. Um, we also think about things across different geographies, and we don't feel like we have to be in every asset category in every geography. Um, the weightings in terms of our long-term plan to those different categories have evolved slowly over time. But when we think about what the long-term plan is, long-term asset allocation plan is, we're really looking at um, uh, some fairly enduring concepts. We're thinking about the core truths of investing, uh, some of the things we discussed earlier about what forms of discomfort there are out there, and then we're thinking about our circumstances as an investor, which forms of discomfort we can bear more um, of, and then certainly whether or not we have any natural or acquired advantages. And the evolution in our long-term plan has really been more about the evolution of our own portfolio and less about um, the world, meaning the evolution of our ability to deploy money well with great partners in these different categories. So there's certainly been an increase in exposure to emerging markets, but that's been as much about an improved capability, or at least greater confidence that we can find great partners in those geographies.
In the end, you really need to have, in order to get this alpha, you really need to have an edge. Now, I guess each of us might have an edge in different types of things, and we can perhaps take advantage of where we do have that edge. We probably don't have an edge across all types of things, and we have to focus where we actually do have that edge. So in general, when you try to take on move in areas where you don't know or you don't have the edge, that's where you're going to have the negative alpha. And of course, a lot of us are in that situation. Of course, you can mitigate those by you can buy passive portfolios. You can even though you might think markets are not efficient, you could act as if markets were efficient by still buying passive portfolios, because at least you're not going to be the patsy in the poker game if you're on the passive side. It's only when you actually, I guess, think you know something that you don't know that you really get in trouble.
Amen.
So we don't have a whole lot of time left. Let's get to at least one more question and maybe two. Here's a question, Roger. Maybe we can start with you on this one. How has the mix of players in the market changed since you were doing your calculations in the 70s, in terms of different kinds of investors and entirely new kinds of investors? And has that had an effect on the larger movement of the market and long-term returns?
I'll actually answer the second part of that question first. I don't, because every time you look at the market, it's always different than the last time. And so times are always different, but generally the distribution, the risks of the market, although it goes through some cycles, it's roughly comparable over time. And so I don't think we have to change our risk premiums so much, or but I do think that the participants in the market and the way the structure of the market is dramatically changed in the last, say, 35, 40 years. It's become, the products have become much more alternative type products. So here I guess to actually ask about the structure of the market, that's really a question that Carl or Andy could answer better. And I'll turn it over to Carl first because he's in the sort of the securitization business and so forth, where you are always restructuring things. Carl?
Yeah, yeah, I agree that the participants, even in the time that I've been in it, which is only from 1980 to the present, we didn't have high frequency traders. There were probably, a handful of hedge funds, alternative asset managers, whatever. Back then, you hardly knew who they were, though. Compared to today, the number that are out there is simply staggering. So you'd be hard pressed to argue against the idea that with all that activity, there's not an impact on the market. Now, that's probably different from saying if you took a really long view, do they have an impact? I'm not sure I know whether they do. What I certainly do think is true is that if your time horizon is 3, 5, 7 years, you'd have to say that yes, there is a number of changes that have occurred as a consequence of what I mentioned earlier, the changes in the supply-demand dynamics across different asset classes.
So here's where I would turn to Andy, though, because even though we know the number of participants have changed and their behavior has changed and the products are so different, are the basics still true about you've talked about discomfort and investing in the products that people don't want? Is the basic concepts that maybe you learned at the School of Management originally, do they still hold up today, Andy?
I think the enduring truths are by definition enduring truths. One of them was your comment earlier about overall it's a negative sum game, and I think as Carl mentioned, the expansion of certain types of firms have made the magnitude of that negative component a lot bigger, that there are a lot more firms charging what would have been considered premium fees in the past, and a lot fewer of those doing so deserve to can justify doing so. So I think market efficiency probably has gotten a little bit more over time, but not as much more as I feared when I first thought about choosing this career. And the inefficiency of fees have gotten worse.
So we have just about a minute left, and I'm going to ask each of you to just give us a quick answer to one last question. If there's one factor that people should be keeping their eye on in terms of thinking about returns over the long term, what would that be? And I'll start with Carl.
I would say if you care about alpha, then complexity is probably where you'll find it. So you're going to have to look at things that make you, because of their complexity, necessarily uncomfortable. It'll be there. I'm not saying you'll get it there, but it's hard to imagine that it won't be in a place where it's complicated to figure it out.
Andy?
Wow, I wish I had gone first. I think one just needs to be sensible and humble about looking at the past, and understand that while I think the past does provide a pretty good guide to the future. It's a very imprecise guide, and one should think through what the implications of that is.
Roger, I'll give you the last word.
Yeah, well, actually, you started off by asking us my old forecasts and how they did. Those forecasts were actually probabilistic. They were in the form of probability distributions. We were probably one of the first people to actually come up with probabilistic forecasts. So we didn't actually come up with a actual number, but a whole probability distribution. I think that's the ultimate key. You don't really know the answers, but you have a good idea, perhaps, of at least what the distribution of possibilities are. And yes, we've learned a lot from the past, not only about the expectations, but also the level of risk, and also a good idea about how much we might miss in our forecasts.
Thank you to all of our panelists, and thank you all for joining us and for your questions and comments. Please send any additional comments or questions to YaleSOM at yalesom@som.yale.edu. A recording of this discussion will be made available at the Yale SOM alumni portal for Yale SOM alumni, that's alumni.som.yale.edu, and at the Yale Insights website, which is mba.yale.edu/insights.